If you're like most people these days, the sheer thought of planning for higher education, maybe for your kids or even yourself, it can feel pretty daunting. Costs just keep climbing. And saving up for that, well, it feels like a real uphill battle sometimes. But there are actually some significant government incentives out there, things designed to make that journey a little less financially painful. So today, our mission is really to unpack those. We're taking a deep dive into the tools the government offers to help with education savings, especially focusing on the tax advantages. We'll look at how they work, what the fine print looks like, and what you really need to know to potentially benefit. Before we dive deeper, though, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, examples, explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely visit the website. You'll find extra practice questions, video lectures, and really detailed support to help reinforce what we talk about today. And a special thanks to Professor Farhat for providing this valuable material. Okay, so when families start thinking about saving for college, one of the first things they might bump into are educational savings bonds, specifically Series E bonds. Let's unpack this. What exactly are these bonds, and why did the government even create them in the first place?
Yeah, that's a great place to start. Understanding the why really helps. The government saw education costs in the U.S. just soaring, right? Often way faster than inflation. So Congress wanted to offer a direct financial boost, an incentive to help people save. And the core appeal. If you buy these specific bonds, the interest you earn, well, it can be completely tax-free when you use it for qualified education expenses. It's basically a response to those rising costs, trying to make college more accessible.
Tax-free interest. That sounds like a huge draw, a really powerful incentive. But like most things involving the IRS, I'm guessing there are strings attached, conditions you have to meet. What are the hoops you need to jump through here?
You guessed it. There are definitely specific criteria. 3 main conditions, really. First, the money you get when you cash out the bond, the proceeds, must go towards qualified higher education expenses. Tuition, fees, that sort of thing. It's not just for general savings.
Okay, specific use. Makes sense.
Second, the bond itself has to have been issued after December 31st, 1989. So basically 1990 or later. Older bonds don't count for this particular break.
Right. Third, the person buying the bond needs to be at least 24 years old at the time they buy it. The thinking there is it's usually a parent or maybe a grandparent buying it for a student, not the student buying it for themselves.
Gotcha. So parent or guardian, usually.
Exactly. But what's also fascinating here is that even with these incentives, there are always limitations, guardrails. We're mainly talking about 2 things, a proportionate share rule and then income limitations, phaseouts, basically.
Okay, so those are the basic requirements. Let's dig into those limitations now. You mentioned a proportionate share rule. What exactly does that mean? Can you walk us through an example?
Absolutely. The proportionate share rule is pretty straightforward conceptually. It just means you can only exclude the interest tax-free in proportion to how much of the bond money you actually spend on qualified expenses. It stops you getting a tax break on interest you cashed out, but, maybe used for something else.
Yeah.
Let's use an example. Say we have Emily in 2023. She cashes out $6,000 worth of these bonds. Let's say that was $4,000 she originally paid, the principal, and $2,000 in interest it earned. But her actual qualified higher education expenses for the year were only $5,000. So she cashed out more than she technically needed for tuition, fees, books, etc.
Okay, so she redeemed $6,000, spent $5,000 on education. How does that affect the $2,000 interest?
Right. So because her redemption, $6,000, was more than her qualified expenses, $5,000, only a part of that $2,000 interest is tax-free. You calculate the proportion, you take the expenses, $5,000, and divide it by the total redemption, $6,000.
Okay, so 5/6.
Exactly, about 83%. You multiply that fraction or percentage by the total interest earned, the $2,000. So $5,000 divided by $6,000 times $2,000. That comes out to roughly $1,667. That's the amount of interest she can exclude from her income. And importantly, this rule applies no matter what her income level is. It's purely about matching redemption to expenses.
That makes perfect sense. Use it or lose the tax break on that portion. Yeah. Okay, but then there's the other limitation you mentioned, the income level. That also matters, right? Modified Adjusted Gross Income, or MAGI.
Precisely. Here's where it gets, well, a bit more complex. The MAGI phase-out, MGI is basically your adjusted gross income with some deductions and exclusions added back in. It gives the IRS a, let's say, broader view of your financial situation. The government is generous, like we said, but usually up to a certain income point. For 2023, there were specific MGI thresholds. For single folks or head of household filers, the benefit starts to phase out or decrease at $91,850 of MGI, and it disappears completely at $106,850.
Okay, so that's a $15,000 range where the benefit shrinks.
Right. And for married couples filing jointly, the range is wider. It starts at $137,800 and is fully phased out at $167,800. It's a $30,000 range. If your MGI is above those top numbers, you unfortunately don't get the interest exclusion at all.
Okay, let's bring Emily back. We figured out $1,667 of her interest was potentially excludable based on how much she spent. Now, what if her MDGI was, say, $100,000? How does that affect her potential $1,667 tax break action?
She's single, right?
Right, single filer.
Yeah.
So her $100,000 MAGI puts her inside that phase-out range, which was $91,850 to $106,850. We need to see how far into the range she is. The range starts at $91,850. Her income is $100,000. So $100,000 minus $91,850, she's $8,150 above the starting point.
Okay, $8,150 into the $15,000 range.
Exactly. So we calculate what percentage of the way through the range that is. $8,150 divided by the total range width of $15,000. That's, let me see, about 54.33%. That percentage, 54.33%, represents how much of her otherwise excludable interest is disallowed or phased out.
Oh, okay. So you reduce the $1,667 by that percentage.
Well, you calculate the disallowed amount first. So 54.33% of $1,667 is roughly $905.73. That's the amount she loses. So her actual excludable interest is the original $1,667 minus the disallowed $905.73, which leaves her with about $761 she can exclude. Wow, okay. So that income phase out can take a pretty big bite out of the benefit.
It certainly can. It really shows how the benefit is targeted more towards lower and middle income savers.
Fascinating how many layers there are. Okay, so bonds are one piece of the puzzle, tax-free interest. But with those proportion and income rules, what if you want maybe more flexibility or maybe higher contribution limits? That leads us to qualified tuition programs, right? What most people just call 529 plans. How do they fit in?
Yes, 529 plans, they are a huge, huge part of the education savings landscape now. Very popular. Unlike the federal savings bonds, these are actually state-sponsored programs. So the specific rules can differ a bit from state to state, which is something to keep in mind. Many are set up as prepaid tuition programs. The idea there is you lock in tuition costs at today's rates, kind of hedging against future increases. Others work more like investment accounts where your money grows based on market performance. But the core idea, the big draw, is that the growth in the account is tax-free if used for qualified expenses. One key thing, though, if the student doesn't end up using the money for education and the parents get a refund, the earnings part of that refund, the interest or growth, that becomes taxable income.
Okay, so the contributions themselves, when I put money into a 529, that's after-tax money, federally speaking, right? I don't get a deduction for putting it in.
That's generally correct on the federal level, yes. You contribute with money you've already paid taxes on. Some states might offer a state tax deduction or credit, but federally, it's after tax.
But the growth is where the magic happens. That compounds tax-free.
That's absolutely the main federal benefit. Any earnings, any growth inside that 529, it's completely tax-free, provided it's withdrawn for qualified education expenses. It's a really powerful compounding effect over time.
And what counts as a qualified expense for 529s? Is it just tuition?
Oh, it's actually quite broad now. It covers the obvious things like tuition and mandatory fees, books, supplies, equipment needed for enrollment, but also room and board as long as the student is enrolled at least half-time. Computers, peripheral equipment, software, internet access, those count too if used primarily by the student.
Okay.
Also expenses for special needs services. And importantly, it now covers up to $10,000 per year for K-12 tuition at public, private, or religious schools.
K-12 too. That's useful.
Yes, and even certain costs associated with registered apprenticeship programs. And a fairly recent, very helpful change, you can use up to $10,000, a lifetime limit per beneficiary, to repay qualified student loans.
Wow. Okay, that loan repayment piece adds a lot of flexibility.
It really does.
Let's use another quick example to make this concrete. Say Anna put $22,000 into a 529 over the years for her son. It grew really well. Maybe it's worth $32,000 now. So $10,000 in tax-free gain, right?
Assuming it stays in the plan, yes.
So when her son starts college and uses, say, $7,500 for his tuition bill, None of that $7,500 withdrawal is taxable income for anyone.
Correct, because the original $22,000 was put in after tax, and the growth portion is tax-free when used for qualified expenses like tuition. So the $7,500 comes out completely tax-free.
Okay. But what about that scenario you mentioned earlier? What if the son maybe gets a scholarship or changes plans and Anna ends up taking some money back out, getting a refund from the plan?
Right, if she takes money out that's not used for qualified education expenses, or if she gets a refund that exceeds her original contributions. So in her case, anything refunded above the $22,000 she put in, that portion represents the earnings. That earnings portion would then be subject to income tax and potentially a 10% penalty as well.
Got it. So use it for education, it's great. Take it out for other reasons, you pay tax on the growth.
That's the basic idea. The flexibility and high contribution limits really make 529s a powerful tool for long-term college savings.
Okay, it makes perfect sense. Now, there's one more main tool often mentioned, the Coverdell Education Savings Account, sometimes called an ESA or even a 530 plan. How does that fit in? Is it similar to a 529?
Yes, the Coverdell ESA. It shares similarities with the 529, especially since it was also expanded years ago to cover K-12 expenses, not just higher education. So it's quite versatile too, but there are some key differences. The biggest one is the contribution limit. It's capped at just $2,000 per year per beneficiary. That's much lower than typical 529 limits.
Okay, only $2K a year. That's a big difference.
It is. Also, the beneficiary, the student, generally has to be under 18 when the contribution is made. Unless they are a special needs beneficiary, then the age limit doesn't apply.
Under 18. Okay.
And like the 529, contributions are made with after-tax dollars, not tax-deductible federally. But again, their earnings grow tax-free and withdrawals are tax-free if used for qualified education expenses, K-12 or higher ed. So it mirrors that key benefit of the 529.
So with that much lower $2,000 limit, who is a Coverdell really best for? It sounds like maybe a smaller scale option.
That's a good way to put it. It definitely occupies a different niche than the 529. Because 529s are often seen as the go-to for larger long-term college savings due to the high limits, the Coverdell can be particularly useful for families maybe focusing specifically on K-12 costs. For instance, if you want to save specifically for private elementary or high school tuition, putting away $2,000 a year into a Coverdell could be a really good fit, getting that tax-free growth just for those K-12 expenses. Or maybe for grandparents who want to contribute something modest each year, but the parents already have a 529 going. It's another avenue. It's really about matching the tool to your specific goal and how much you plan to save annually.
Right, different tools for different needs or scales of saving.
Exactly. And if we kind of zoom out and connect all the Series E bonds, the 529 clans, the Coverdell ESAs, what they all fundamentally leverage is the tax principle of gross income exclusion. This is so critical in tax law. The default is basically everything you receive as income and potentially taxable, unless there's a specific law that says it's excluded. These education savings programs create those specific exclusions. They allow certain interest or growth, when used for education, to be legally excluded from your gross income. That's the power behind them.
That's a really helpful way to frame it. So wrapping things up for today, we've looked at quite a landscape. We covered educational savings bonds with their tax-free interest potential, but also those proportionate share and MBGI rules. Then the really popular 529 plans, state-sponsored, great for tax-free growth on potentially large sums, very flexible uses now including K-12 and loan repayment. And finally, the Coverdell ESAs, similar tax-free growth, but with that lower $2,000 annual limit, perhaps better suited for K-12 or smaller savings goals. Each has its own, quirks and rules, but the common thread is helping you save for education with some valuable tax advantages. Hopefully being informed about these helps you navigate those choices.
Absolutely. And look, the rules, especially the phase-outs and details, they can seem a bit complicated sometimes. It might feel like financial gymnastics, but the core benefit is really clear. These programs exist to lower your tax bill on money you're setting aside for a major, often essential, life expense education. Thinking about which tool, or maybe even combination of tools, best fits your family's financial picture and your specific savings goals, that can make a real difference down the road.
Definitely. And it leads to maybe a final thought for you, our listener, to mull over. Thinking about this principle of gross income exclusion that applies here, how might understanding that power, not just for education, but more broadly, shape how you approach other long-term financial goals? It's a fundamental concept in managing your finances effectively through the lens of taxation. Something to think about. And of course, if you want to dive even deeper into these education incentives or other gross income exclusions, practice calculations, really solidify your understanding. Remember, resources like farhatlectures.com are there with lectures, practice questions, and detailed explanations. Definitely check it out. Until next time, keep digging deep.